Hi, Greg Dorsey here. It's September 7th at Leeb.com, Leeb.com. Well, stocks ended last week on a three-day tear, gaining 5%. Much as we'd like to see indications that the economy remains on firm footing, however, we can't get too worked up about the news that fueled the move. With Friday's employment report, for instance, while non-farm payrolls were better than expected, the pace of job creation was not fast enough to prevent unemployment from rising. Likewise, last Wednesday's ISM Manufacturing Index looked good on the surface, suggesting that industry is expanding. But the rise in prices paid doesn't bode well for corporate profits when companies can't pass higher costs on to their customers. The tone of the market today was decidedly more muted, however. Equities took their cue from Europe, where debt concerns are surfacing once again, as are questions about the health of European banks, many of which will have to be recapitalized at some point. Also adding to the concerns, German factory orders unexpectedly fell in July. Now, this news strongly suggests that the Germans, which are the real engine for growth on the continent right now, are not going to be able to repeat the solid growth their economy produced in the second quarter. Closer to home, President Obama has announced a $50 billion proposal for spending on infrastructure over the next 6 years, although he doesn't want to call it a stimulus package. It's in fact what it is. He's also expected to unveil some new tax breaks later this week to help jumpstart what is clearly a decelerating economy. Given the economy's rather feeble response to the last fiscal stimulus program, the stock market is largely ignoring the news. Speaking of news, this week is rather light on U.S. economic reports. We will, however, be watching data out tomorrow from the Federal Reserve on consumer credit. While credit is set to contract again, we'd like to see the pace of that contraction at least slow a bit further. But then again, we're not holding our breath. If it doesn't, it would be one more reason for traders to head for the exits. Now, from a technical perspective, last week the rally carried the benchmark S&P up to the 1100 mark and the Dow Industrials to 10,400. During the past year, these levels have variously acted as support and resistance. Right now, they represent resistance, making it a logical stopping point. At the very least, we need to consolidate for a period, and more likely we'll retreat at least to the 1060, 1070 area on the S&P. The dollar is turning in mixed results this week. The greenback is gaining on the euro, but it's at a fresh 15-year low against the yen. The real winner is gold, which is money that everyone can trust. Gold is just shy of its record high as of today's close, and while a modest pullback in the near term isn't out of the question, the upside far outweighs any likely near-term correction. So again, we just can't pound the table loudly enough for gold. That's it for now. Be sure to stop by later this week, and we'll see you then.